When the United States launched a trade war against China, imposing tariffs on billions of dollars worth of goods, it was a move that sent ripples throughout the global economy. The expectation was clear. The world expected China to buckle under the pressure. Many analysts predicted economic hardship and a significant slowdown for the Chinese economy. For years, the story was simple, a well-established pattern of international trade. China made, America bought, fueling China's economic growth and providing affordable goods to American consumers. Without its biggest customer, the United States, China's export-driven economy seemed doomed to face a severe downturn. The conventional wisdom suggested that the trade war would cripple China's manufacturing sector. But China didn't flinch. Instead, it adopted a posture of defiance and resilience. It matched tariffs, imposing its own levies on American goods, restricted key exports, strategically limiting the supply of crucial resources, and signaled to the world that it was ready for a fight, prepared to weather the storm and defend its economic interests. This was a new, assertive China, a nation confident in its own capabilities and determined to chart its own course. Unfazed by the threat of losing the U.S. market, demonstrating a newfound economic independence and strategic vision. How could a nation so dependent on American buyers, a country that had for so long relied on exports to the United States, retaliate with such confidence, displaying such unwavering resolve in the face of economic pressure? The answer, a strategic shift years in the making. China had been quietly transforming its economy for years, laying the groundwork for a more resilient and self-reliant economic model. Instead of just spending on immediate consumption, China strategically invested nearly 40% of its GDP, a massive allocation of resources, into key sectors like technology, infrastructure, and domestic industries, building a foundation for long-term growth and competitiveness. This investment rate is double the rate of any other major economy, showcasing China's commitment to future economic dominance. The ultimate goal: become a self-sustaining powerhouse driven by innovation and domestic demand, not just the world's factory churning out goods for export. The results of this strategic shift are now becoming increasingly clear. Chinese companies now challenge and even surpass Western rivals in key industries, demonstrating their growing technological prowess and market dominance. BYD, for example, has overtaken Tesla, a company once considered the undisputed leader in the electric vehicle market, as the world's largest electric vehicle maker, signaling a significant shift in the global automotive landscape. TikTok, a Chinese innovation in the realm of social media, has become a global social media force, captivating audiences worldwide and reshaping the way people consume content online. Across sectors, from electronics and renewable energy to consumer goods and advanced manufacturing, Chinese brands are increasingly moving up the value chain, offering higher quality products and competing in premium market segments. China isn't just surviving without America as its primary export market. It's proving it can innovate, lead in key technological areas, and thrive on its own terms, reshaping the global economic order in the process. The world's expectations about China's economic trajectory have been fundamentally upended. A new economic reality has arrived, one where China is a dominant force, capable of shaping the global landscape. For decades, the U.S.-China economic relationship was built on mutual benefit. China supplied cheap labor, America provided capital and demand. China's factories powered global supply chains, fueling rapid growth and attracting trillions in investment. But as China's economy matured, it became smarter, not just cheaper. By 2010, China was the world's second-largest economy, producing advanced electronics and telecom equipment. America's trade deficit with China soared, sparking alarm in Washington. The narrative shifted. China was now seen as a strategic threat, not just a partner. Accusations of unfair trade practices and protectionism mounted. Political momentum for confrontation grew, culminating in sweeping tariffs and tech restrictions under President Trump. The U.S. blacklisted Huawei, restricted chip sales, and signaled the end of friendly engagement. The era of decoupling had begun. A new contentious chapter in U.S.-China relations was underway. Facing trade tensions and the threat of decoupling, China unveiled a new strategy: dual circulation. The plan? Build a resilient, self-sustaining economy less exposed to Western pressure. Internal circulation focuses on boosting domestic consumption, local supply chains, and homegrown innovation. The aim: make China's 1.4 billion citizens the main engine of growth. External circulation shifts trade away from the US and Europe, forging new partnerships across the global south. By diversifying trade and strengthening its internal market, China hedges against future shocks. This isn't a retreat from globalization, it's a reimagining, with China at the center. Dual circulation is China's answer to decoupling, not just to survive but to thrive. The blueprint is already reshaping China's economy. The heart of China's new economic strategy is undergoing a significant transformation. It's a shift that could redefine its role in the global economy. It is turning its people into spenders, active participants in the economy, and not just savers, carefully putting money aside. This pivot towards consumption is a key element of their plan. Domestic consumption now accounts for a substantial 45% of China's GDP, a figure that highlights the growing importance of internal demand. That's more than double what exports contribute, signaling a major rebalancing of their economic drivers. This shift reduces reliance on external markets. Chinese consumers are increasingly embracing homegrown brands, showing a preference for products made within their own country. This includes everything from innovative BYD electric vehicles, showcasing China's advancements in technology, to cutting-edge Huawei phones, demonstrating their capabilities in the telecommunications sector. Government policies actively encourage this shift towards domestic consumption and supporting local industries. They are doing this with various subsidies and readily available cheap loans designed to boost consumer spending and stimulate the economy. But despite these efforts, significant challenges still remain on the path to a fully consumer-driven economy. Chinese families traditionally still prioritize saving a larger portion of their income compared to their Western counterparts. This is often driven by a sense of caution, wary of potential gaps in social safety nets, and the ever-present specter of economic uncertainty. Furthermore, the property market is currently facing a significant crisis, impacting consumer confidence. Adding to these concerns, the population is aging at an accelerating rate, which presents its own set of economic pressures. All of these headwinds combine to make it more difficult to fully unleash the potential of domestic consumption and achieve sustainable growth. Still, despite these obstacles, the fundamental shift towards a consumer-driven economy is undeniably underway. China's economic growth is becoming increasingly driven by the purchasing power and demands of its own people. While the transition is far from complete and faces ongoing challenges, the overall direction of travel is clear and points towards a more internally focused economic model. China is actively building an economy that is significantly less reliant on exports to drive growth and prosperity. Instead, the focus is shifting more and more towards harnessing the power of its vast and rapidly expanding domestic market. The world's biggest consumer base is awakening, ready to spend and shape the future of the Chinese economy. The stakes couldn't be higher as China navigates this critical juncture in its economic development. As China strengthens its domestic market, it's also pivoting its trade toward the global south. In 2000, the U.S. took over a fifth of Chinese exports. By 2023, just 15%. But China's global export share kept rising. It simply found new buyers. Southeast Asia, Africa, Latin America, and the Middle East now drive demand for Chinese goods and technology. ASEAN nations have overtaken the U.S. as China's top trading partner. In Africa, Chinese investment in infrastructure has unlocked new markets and resources. China is now the top trading partner for Brazil, South Africa, and Indonesia, key BRICS members. Diversification gives China a crucial buffer against Western pressure. It's no longer just the West's factory, it's the economic hub of a new global order. If this bet pays off, it could reshape global trade and power for generations. The world map of commerce is being redrawn. Central to China's global strategy is the Belt and Road Initiative, the most ambitious infrastructure project in history. Launched in 2013, it's a modern Silk Road roads, railways, ports, and digital networks connecting China to the world. Over $1 trillion has been invested with 140-plus countries signed on, covering most of the world's population and GDP. The BRI isn't just about infrastructure, it's about influence. By building vital projects where Western investment lags, China secures loyal partners and long-term demand for its goods. ASEAN, a key BRI region, now buys $500 billion in Chinese exports annually. The BRI is the backbone of China's external strategy, embedding it deep into global supply chains. China is connecting the world on its own terms. To achieve true independence, China is building a powerful tech and industrial base. Massive state investment targets semiconductors, electric vehicles, and advanced infrastructure. When the U.S. restricted chip sales and targeted Huawei, China doubled down. In 2023, Huawei unveiled a smartphone with a homegrown 7-nanometer chip, defying expectations. BYD surpassed Tesla as the world's top EV maker, thanks to years of strategic support. China leads in high-speed rail, green energy, and 5G networks. Overcapacity, producing more than it can use, isn't a flaw, but a feature. By flooding global markets with affordable, high-tech goods, China embeds itself in supply chains worldwide. This strategy makes the world more dependent on China. Overproduction is China's economic weapon. China's rise is powered by state-led capitalism, government-driven, fast, and focused. This model enables rapid growth and grand projects, but comes with risks. Public debt is soaring, with ghost cities and idle factories as warning signs. Overcapacity and heavy subsidies can crowd out private innovation and create inefficiencies. Top-down control delivers results but can stifle the entrepreneurial dynamism seen in the West. The system's strength, state power, is also its vulnerability. Demographic decline, property crises, and mounting debt are deep challenges. China's future depends on managing these contradictions as it navigates a changing world. The balance between control and flexibility will define its next chapter. The US-China relationship has fundamentally changed, evolving from a partnership to a complex competition. This shift marks a significant turning point in international relations. The era of quiet interdependence, where both nations benefited from close economic ties, is definitively over. The landscape has shifted, revealing a new dynamic of strategic rivalry. China no longer needs America as it once did, having cultivated its own robust internal market and technological capabilities. It stands as a self-reliant global power. It's building new factories at an unprecedented rate, expanding its manufacturing base and solidifying its position as a global production hub. Alliances, forging new partnerships across the globe to extend its influence and secure access to vital resources. And technology at home and abroad, investing heavily in research and development to become a leader in cutting-edge industries. But China isn't untouchable. It faces its own set of economic and social challenges that could impact its trajectory. Domestic consumption lags behind expectations, hindering efforts to transition to a more balanced, consumer-driven economy. Its chip industry trails global leaders, creating a vulnerability in its supply chains and limiting its technological autonomy, and property and debt crises persist, posing a systemic risk to its financial stability and potentially impacting economic growth. Still, China has built a powerful alternative to Western-led globalization, offering a different model of development and international cooperation. It's not retreating, it's rebuilding, reshaping the global landscape with its ambitious infrastructure projects and strategic investments, crafting a parallel economic system embedded in the global South, fostering closer ties with developing nations and challenging the dominance of traditional Western institutions. This is a contest over who sets the rules for the 21st century economy, a battle for influence and control in a rapidly changing world order. For the first time in generations, the US can't call all the shots, as its economic and political power is increasingly challenged by rising global players. The age of American-led globalization is fading, giving way to a more fragmented and competitive international environment. A contested, multipolar world is emerging, where power is distributed among multiple centers, creating new opportunities and challenges for all nations. The question isn't if China can survive decoupling from the West, but how resilient its economy will be in the face of these challenges. But how the world will adapt to two economic centers of gravity, navigating the complexities of a bifurcated global economy. China's quiet revolution is reshaping trade, investment, and geopolitical alliances across the globe. Capital, as it seeks to internationalize its currency and challenge the dominance of the US dollar. And power for everyone as nations realign and compete for influence in this new era of global competition. A new era in global affairs has begun, marked by uncertainty, opportunity, and the need for adaptation. The world must adjust to this new reality, embracing innovation and cooperation to navigate the challenges and opportunities that lie ahead.